Okay, good afternoon and welcome to everyone calling in today to learn more about Ocean Park and its positioning and performance. We're fortunate at Michigan Money Management to be able to continue to serve you and the rest of our friends and clients through what has become one of the most challenging times in our careers. We hope and pray for you and your families and the world's leaders to get us through this health, economic, and liquidity crisis so that we can make the world a better place for future generations to come. We have allocated millions of your and our other clients' monies into Ocean Park and other strategies to help de-risk portfolios. And we are very happy to share Ocean Park's successful results and to encourage you to consider further allocations. I looked at an account a little bit ago that was up a little over 3.7% net of fees over the trailing one-year period through yesterday. The team here at Michigan Money Management, including Marlena, Kathleen, and my advisor partner, Nate Whitson, are happy to have our esteemed Ocean Park executive, Jeff Johnson, with us today to lead the call. And before turning the call over to him, I'd like to just review some of his background. Jeff's been around the industry since 2006. He's currently a regional sales director for Sierra, the mutual fund company, as well as Ocean Park Asset Management. Ocean Park and Sierra were founded back in 1987. They currently manage over $4.5 billion in separate accounts and mutual funds that are designed to serve the needs of retirees and other conservative investors. Sierra's globally diversified tactical style has delivered exceptional results across market cycles due in part to application of its integrated risk management disciplines. That's one of the things that Nate and I sought out when we were looking for some hedge or de-risking strategies, was somebody that had a disciplined style that wasn't making decisions based on emotions. As we all know right now, it's easy to let the news or what we read, a white paper, a newspaper column, something on the internet, make us sway one direction or another as to whether we're feeling bullish or bearish or ready to jump off the ledge or to put all our money and all our chips in. So we've really strove to find a provider with that discipline, and Jeff and Ocean Park really fit the bill quite well. Prior to Jeff coming on board with Sierra and Ocean Park, he worked for a number of other firms, including Calamos Investments, a mutual fund company many of you have owned over the years, and Bear Stearns, both in Chicago. Jeff is a graduate of the University of Illinois at Urbana-Champaign, holds a BS in agricultural finance. In addition, he was a member of the University of Illinois Fighting Illini men's golf team. In his free time, Jeff continues to play golf both recreational and competitively, as well as enjoy time with his wife, his beautiful one-year-old daughter, and their 2-year-old Bernese mountain dog while living in Metro Detroit. So without further ado, I'm going to turn it over to Jeff. He has about 20 minutes of prepared presentation. Again, if you have any questions, don't hesitate to email Kathleen, Nate, or Tom at our emails, and we'll try to sift through and get that down to a finite number that we can fit into a call in the next 30 minutes. Thanks for your attendance, and again, thanks for your support. Here you go, Jeff.
Oh, thank you, Tom. Can you hear me okay?
Yes.
Excellent. Yeah, thanks for the kind introduction, and thank you all for joining in at a pretty crazy time. I was saying to Nate 10 or 15 minutes ago, I have more appreciation for the movie Groundhog Day at the moment, as you know, we're all waking up seemingly trying to recreate the previous day and try to make things a little more different. So you know, the good news is we get to take advantage of some technology that's been around for all of us to try to connect with each other. I know I've been doing that with friends and family, and Tom and Nate and the whole team, kudos to them for really thinking outside the box and wanting to, I've been impressed with their overall communication internally at their firm and from what I've seen so far working with them and you all, the clients. That is in part what makes them, really top-notch financial advisors. And I meet with a lot of them on a daily basis. And they certainly do a wonderful job, and I've been impressed, since day one. So here we are taking advantage of some technology, and I'm excited to share an update with regards to Ocean Park, which I know many of you have a significant holding in. A lot has happened in the past few weeks in particular. And so it really was a good time to make sure you all had an idea of what's going on with our particular section of your portfolio. And fortunately, it's been a bright spot. It's sometimes hard for us internally at Ocean Park to wrap our head around, kind of getting excited when seemingly there's a lot of, pain and suffering and scary things going on in the world. And we were built for times like these. And so we get excited in a very humble and sincere and genuine way as we do a pretty darn good job and have over many years, which we'll go through, of protecting capital when there's unusual market volatility. So I was taking notes, as I often do when Tom and Nate and the team talk, because they're very insightful and got a lot of great ideas to share. And one of the things I've also been impressed with them as financial advisors and money managers, what sets the good ones apart from the not so good ones is putting this whole complicated puzzle together. And there's a lot of options out there. There's a lot of firms like us that do many different things. It's like Baskin Robbins, 31 flavors. Most of us know the chocolate and vanilla, the stuff that hits the CNBC headlines each day. But there's 29 other flavors that got a lot of different stuff in them and do different things, and we're one of those. The couple of the buzzwords I wrote down were hedging your bet, a core investment, and a buffer. And those were really good ways to describe our role within your all's portfolio. I'm reminded as a kid, when my parents took me to the bowling alley, probably mainly because I just wasn't very good at bowling, but it was nice to have those bumpers in the gutter. So you could roll it down there and not have to think too much without it making it to the other end. And that's a pretty good analogy for Ocean Park. We've got bumpers on at all times to make sure that you all aren't opening statements that are saying, what happened? Why is this one down along with the other stuff when it wasn't supposed to? So yeah, I think our role, as Tom laid out, as a kind of a core holding, a hedge on some of the more volatile investments that, are supposed to go up and down. I know sometimes when these big, scary, unusual, volatile environments, we want nothing to go down, but that's just the reality of investing, in my eyes, is that's often how many asset classes and investments are supposed to handle. And the important thing is diversifying and having a plan to offset some of those. So I'm speaking for them a little bit, but based off of how Tom laid it out, because I thought it was very applicable as to right now. So the three parts of my presentation that I'm going to go through in the next 10 to 15 minutes. First is our process. And this is the marketing piece that if you don't have in front of you, that's okay. We can make sure that you do have it afterwards. but it's a two-page document that goes through our investment process. And this is really the cornerstone, the DNA of our firm, and what differentiates us from many money managers out there. Going back to the bowling analogy with bumpers in there, we specifically engineered a process to manage risk. And so you're not relying on and you're not paying for our co-founders and our investment team to make great calls and figure this thing out. What I'm not going to say on this call is what our view is on the coronavirus and how it's going to impact the economy. We're not going to tell you how it's going to impact the election and how that's going to affect the economy and what unemployment exactly is going to be at and what the Fed is going to do or not do, and what the administration is going to do or not do in the stimulus. There's time and place for that, and fortunately you've got a great team that's keeping abreast of all those nuances that's going on. For us at Ocean Park, that's not what you're paying us to do. You're paying for this process, which is discipline and is designed specifically to take much of the emotion and ego and guesswork out of really three basic tenets to portfolio management, which is 1, what to buy, 2, when do you buy it, and 3, when do you sell it. So we're going to go through this piece in a little more detail. Then we're going to move on towards what's been happening lately. We've got a specific marketing piece that details exactly how we've protected and what that looked like in the past few weeks and why we've been able to manage risk so well and what that means more specifically. And then lastly, we're going to talk about our track record, give it a little more perspective, go more 30,000 feet to show you what this process has done, not just in the past few weeks, but over 20 plus years, which is one of our unfair advantages, is we've been doing it for a long time, which is comforting. So we'll start as a refresher of our process. I mentioned when to sell, when to buy, and what to buy. And we're going to start with when to sell, because that's actually the easiest part for us. There's many different types of investments, stuff that you probably own that isn't meant to sell. You're meant to hold it for a long period of time. And so there's a difference there that's important. But for what the industry calls tactical as opposed to passive, we are a tactical manager that does have the ability to sell and get out of the way, get out of the market, and move to cash to protect from losses. And so I'm going to zoom in a little bit here and focus on these squiggly lines. And this is an oversimplified version of our process, but does a good job of kind of visually showing how our process works. And so the smooth green line is what the industry calls a moving average. This is a piece of technical analysis that our team uses to guide the ship as to when to buy and when to sell. So if the red squiggly line is an example of one of our underlying holdings, when it makes a top and trends down, you see it crosses down through the moving average, and there's a red arrow there. That is a trailing stop loss. When you go up to 1, when to sell, it talks about our trailing stop loss discipline. And so what's a trailing stop loss? Just think of it as a seatbelt, or a stop sign, or a parachute, or maybe the bumpers in the bowling alley. It is a physical barrier that we use to trigger when to sell. So As we'll get into in a bit, we've moved to a lot of cash. And so the point with this when to sell and our trailing stop loss discipline is, we didn't get nervous. We didn't say, oh my gosh, I see what's going on in China. Should we sell? I don't know. Is this going to get bad? I'm not sure. Our team 33 years ago, and we started in 1987, specifically designed the sell side of the world, the sell discipline, to be 100% quantitative. So 100% unemotional, no guesswork, no worry. And that's what a trailing stop loss is. When it moves through the band, it triggers a red flag and we just sell and go to cash. So that's kind of the easiest part. It's the hardest part for some managers who are tactical. For us, it's the easiest. It's 100% quantitative, unemotional, and it allows us to avoid downturns. And part two is when to buy. So the opposite of the sell is the buy signal. So if we go to cash, when do we get back in? It's the same concept. When something makes a bottom, we wait for it to go up. And if you see that green arrow, it crosses up through the band, and that's our buy signal. And you'll notice this green arrow isn't down way at the bottom. If you can find a manager that can have a green arrow at the exact bottom, as I said in one of the last client meetings with the Michigan money management team, if you can find that manager, please tell me. I used to say, because I'd be on the golf course now and not working. Unfortunately, the golf courses are all closed, so I'd be doing something else enjoyable besides working. And the point is, no one can call the tops and bottoms. You have to build in a process to try to put yourself in the best position. So that's why our buy signal, it takes some trend to develop. It's not the bottom of the first inning of the ball game. It's maybe the second or third inning of the baseball game. I know Tom's a big baseball fan. So that's important. We can't know, call the exact day and get back in. And there's got to be some trend to take place before we get back in. So that's the buy signal. And part three is what to buy. So we are what the industry calls a unconstrained manager. So there are equity mutual funds and strategies. There are fixed income strategies. There's commodity strategies. There's real estate strategies. There's a lot of different kind of stuff. We're the jack of all trades. We can go anywhere. And so that's the most complex part of the equation, because what if you're on multiple buy signals in many different asset classes? And so our team has built in processes and disciplines to kind of figure out how we allocate amongst all of our buy signals to create a very diversified portfolio, which we'll get to when we look at our fact sheet. In general, we try to favor asset classes with lower volatility. So, for example, we like the fixed income side over the equity side because it's less volatile and it's slightly easier with our process to get in and out of. So those are the three steps of the process. I hope that kind of makes sense. I know it's perhaps a lot at once, but this piece does a good job of laying it out. And I did want to, even though it's a little in the weeds, I wanted to make sure to highlight our process, because that really, as I mentioned, is the cornerstone of the firm, is following a disciplined, rules-based process built by an engineer and a PhD with an emphasis in statistics, a math geek, to hit singles and doubles and try to keep losses at to a minimum. I think I said earlier, to avoid downturns. You can't, when we go through our track record, you can't always avoid any losses. If you could find me a manager that could give you 0 red numbers, please tell me that one as well. So our strategy more is about keeping losses to a minimum, as small as we can. And if you do that over time, you put the math in your favor. So that's part 1 of the presentation, our process. It's been running since 1987, and it really guides the team as to what to buy, when to buy, and when to sell it. So now let's move more towards what's been happening as of late. We publish these pieces that are approved for your all's consumption on a monthly basis. If you're ever curious, email one of the wonderful teammates at Michigan Money Management, and they will get you a copy. It talks about changes in our allocation on a monthly basis. And because we had such significant change in the middle of the month, in the middle of March, we actually did a special release of this piece because even monthly was too long of a time frame to show what we did and how we protected. So I'm going to start with actually the second page to give you a little bit of a bird's eye view this year. So as of December 31st, 2019, we were fully allocated. So I mentioned we are unconstrained, jack of all trades. We use a lot of different asset classes. It's a very highly diversified, very robust strategy that can invest in a lot of different stuff. And so as we were invested most of last year, we were invested in a lot of stuff. And you see the cash is at the top here. So we only had about 2.1% cash, the rest fully invested. January, we saw a little bit of volatility. And we hit, remember our trailing stop loss discipline. It's not the team saying, you know, I'm getting nervous, let's move to cash. It happens automatically. And so we got stopped out, as we say. We exited into 5.4% cash. February, we saw a little bit more volatility creep up, and the cash position grew to 27.6. And then, unfortunately, the reality of our current situation started to kick in, and it was, it was a crazy few days there where we were getting emails internally saying, we hit another stop, we hit another stop, we hit another stop. And in just a couple weeks, we went from 27 to 96.2% cash. And that is a very unusual occurrence. And that's how dramatic of a sell-off this has been. There hasn't really been very few places to hide. Both the equity and the fixed income side has been very volatile. And that's what makes us such a compelling idea as a core investment, a hedge on hedging your bet and a buffer, as Tom laid out. Because our main way to manage risk is to not to try to figure it out, not a very, this is rather complex, but not in the traditional sense of how other managers hedge themselves with complicated investment tools and trading strategies. Ours is actually fairly simple. We use stop losses and under mutual funds as underlying holdings, and just simply hit the sell button when we hit stops and go to cash. And sometimes holding a lot of cash can be very beneficial. So it's that move to almost 100% cash that allowed us to avoid almost all of the volatility that happened this year. And we find ourselves in a really good position at the moment. with a lot of, as we call, dry powder to put to work as soon as those buy signals start kicking in. So that's a refresher on what's been happening lately. It really was the bulk, meant to be the most important part of the presentation, also to get you updated on our process, but mainly, and again, kudos to to your team for wanting to communicate in a timely fashion exactly what's going on, and to share a bright spot, which is our ability to keep a portion of your account, in a safer position. So that's the most recent updated, and then we did want to make sure we update, or not update, just refresh you on our track record. So this is the fact sheet as of 12/31 of last year, Q4. I'm looking forward to the update with the performance number for this quarter, because compared to other stuff out there, it's going to look more favorable, and this is really cool. This is, candidly why I joined this firm over 8 years ago. I didn't, frankly, know many of these tactical risk management firms, and there's a lot of great stories out there, and Tom and Nate and the rest of the team hear them every single day, I can assure you. Different stuff walks through their door, and a lot of it sounds great. And what initially piqued their interest and started a fairly intensive and comprehensive due diligence process was our ability to protect during not just '08, but even farther back, going through the tech wreck all the way back to '95. And that shows consistency, and it shows that your process works. If you're going to have some sort of risk management, tactical, active strategy that you're paying for, usually, a higher fee than more lower cost, more passive investments, you better do what you say you do, and you better do it when you really need it. And we've done that, that we can demonstrate since '95. And we did it again in this downturn, and it's refreshing for me to represent this firm on the sales side, to again once again do what we say we do, which is not have you all open statements with your jaw dropping, saying why the heck did this thing that was supposed to be safe not be safe, and ultimately be a nice buffer to the other stuff that is not meant to be sold based on emotion. And that is coming up at 1:30, and the conclusion of my prepared remarks. I hope that was helpful, and I appreciate the opportunity and the time for you to either learn about Ocean Park or get refreshed on and see what's been going on under the hood in this part of your account. And if you have any other questions, offline that I can help with, certainly email your team, and I can be of help any way I can. And so again, I thank you, and I guess we'll kick it now back to Tom and Nate to see if they have any questions or comments, or any questions that come in via email. I'm happy to stay on and answer.
Thank you very much, Jeff. So one of the questions that I've gotten quite a bit over the last couple of weeks is this the right time to add to my Ocean Park? Or from a number of folks, is this the time to initiate a position into Ocean Park?
Yeah, it's a good question. So because it's pretty unique, because of our process, and our ability to, move out of the way, we generally guide folks that there's not really a best or worst time to be in our strategy. We feel our process can deliver these kind of consistent results, hitting singles and doubles and keeping the downside to a minimum best we can, and kind of hold us, at all times as the buffer. I will say that what we're excited about now, even if if you're thinking to yourself, man, I wish we would have had more in this and that kind of thing. Of course, part of your plan, you never want everything all in one basket, and so you all do a phenomenal job of putting all the eggs together in a cohesive way. But more specifically, to answer your question, what's exciting moving forward, and not just the protection part, is our buy signal part. And we've got a lot of cash, dry powder to put to work to jump on trends when they develop. So, you never know how, no one can predict the future, but if there was a better time than not, I certainly would think it would be when we've got, cash to put to work if we do see positive trends that develop in the market. So hopefully that made sense.
Absolutely. Thank you, Jeff. So one of the things that Nate and I have talked to most of you about is this concept of de-risking and hedging. And we do this not because of everyday markets, the positive years. We do it specifically for circumstances like today, and where we've helped collectively all of you and our clients to position well over $20 million of assets with Ocean Park, and well over another $20 million in a variety of different products with guarantees of principal or guarantees of income. Those dollars are all hedges for the volatile periods. And if you look at Jeff's chart up on the screen right now showing the tech bubble bursting and the numbers from 2000 through 2003, where clients net grew their money with Ocean Park, or the subprime meltdown and what they call infamously the Great Recession, and the growth in 2009 that was actually better than market growth on the upside. That's exactly why we're with them today. And while there's no guarantees, a good track record and managers who have been there, done that before is very reassuring for us. And at the same time, an investment like Ocean Park, which because of our negotiated fees have averaged over 7% net of all costs, is a pretty nice way to position money, because the fixed income markets are near zero and cash is near zero. So it's kind of stocks, which would add considerably more risk even at these levels, or something like Ocean Park. So again, we're really happy to have put Ocean Park into our sort of quiver, if you will, as one of the options we use. And I think Plato said it best, necessity is the mother of invention. We didn't know what was coming, but we did know the markets were way overpriced. And we knew that Ocean Park, in its discipline of stop losses, would get people out after a little loss instead of a big loss. So, I personally want to thank you, Jeff, and Ocean Park, and the people handling the money day to day at Ocean Park. It's partners like you that really make our jobs easier. And I think the last sort of point to make is, again, that Ocean Park has had really nice performance, but it's not very stock-like in its attributes. And again, if you could just comment, Jeff, to long-term because you've been around with Ocean Park longer than Nate and I have, sort of what their typical allocation has been, not just let's look back at the last few months.
Yeah, good question. And thank you for those comments. I appreciate it, and we'll pass it on to the team, because they like, sometimes they're in their own bubbles and wondering, is anyone out there? So it's good to hear from the end users. So the benchmark we use, which you're allowed to pick whatever benchmark you want, what we think is fairly appropriate is what's this called the Morningstar. I'm highlighting it here if you can see. Morningstar allocation 15 to 30% equity category. So those are multi-asset managers that, on average throughout cycles carry around 15 to 30% equities. And we think that's a fairly appropriate kind of guesstimation of what you all could expect as to how much equities we have in the strategy. And we are a bit different in that sense. Before all this cash positions happened, last year was actually a really good example of that. If you look at our top holdings, this was at the end of last year, where we were up net of all fees, including platform fees and advisor fee. This actually displays, I think, a higher fee than you all are exposed to. But anyway, net of everything, at least how we have it laid out, we were up 7.05. And so how did we get there? We got it through high yield bonds, muni bonds. A lot of those are actually high yielding muni bonds, preferred equities, so not traditional common stock equities, but preferred, which has an income component to it, and emerging market debt. And so why would we own those for over other equities that were on a buy signal? International equities at 6.4 and domestic equities at 1.1. That goes into, it's very purposeful. It goes into the, if I flip back to the most complicated part of our equation, is what to buy. Often there are multiple asset classes and uptrends. And as I mentioned, we give preference to asset classes with low volatility. And so what does that mean more practically? Our stop losses on the income-oriented asset classes are generally tighter, more narrower than the stop losses on the more volatile asset classes. Things that are more volatile, you have to let them kind of do their thing. And so it's therefore more challenging to be tactical and use our discipline, our stop loss discipline, with very volatile asset classes, because you end up having to give up a lot of the upside before it trends down and hits a stop loss. So that was a long-winded but hopefully helpful explanation of, yes, we can buy equities. If you had to pick an average, it is that kind of 15, 20, maybe 30% at most. The highest we've been in my recent memory is around 40%. And we prefer the more income-oriented side because we can manage risk far more efficiently. And that certainly has played out this year. If we ignored that preference and we're in 60, 70, 80% equities, where those stop loss levels are, you would have seen a much bigger drawdown, a much worse performance than the use of the income side, which allows us to attempt to keep losses at a minimum.
Thank you very much, Jeff.
You bet.
We appreciate everybody taking the time to become more informed, and we appreciate Jeff and Ocean Park support We couldn't do it without all of you. And this is one of those rare scenarios where we do get combined buying power, where we've been able to negotiate a lower cost because of all of your assets. And that's unusual. Again, you cannot do that in utilizing a mutual fund. Each one of you would have your own implied fee schedule based on the prospectus. So this being an institutional type product, a separate account, we've been able to get more from the relationship in total that you have with us. So we appreciate that. We hope to lead the way out of this crisis and always make our number one goal to serve you and to help you achieve financial success. We'll continue to keep our eyes out for other options that we think will, on a risk-adjusted return basis, allow us to help you to maintain your overall plans for retirement, your financial planning success. Keep an eye out for a replay in case you have other folks that you think would benefit from knowing about us and Ocean Park. This will be in again, a replay format that Kathleen will get out to all of you. And again, this will be the end of today's session. We've kept it to 45 minutes, I guess, in total. And you're all welcome to sign out, hang up, log off. Thank you very much. And let's hope it's a good finish to the first quarter.
Thank you all. Have a great rest of the day, and everyone stay safe out there.